So maybe for the listener who doesn't fully understand what pref equity is and maybe why they're seeing so much of it now, and you did explain a little bit to it right there, but just speak to what it is.
I invested a lot of multifamily, but then what a lot of people don't think about or realize, if you're newer to investing in this kind of private real estate markets, you mostly probably invested in common equity, right? And so if you're investing in common equity, which is what most of the offerings that you see, you get all the potential reward, right? And that's the targeted IRR that you see on that pitch deck. But you take all the risk. So what happens is you're taking all the risk with the first dollar loss. So I think it's really important to understand, am I diversifying not only in the types of assets I'm investing in, but also where I'm investing at in the capital stack. And it's basically sitting behind the senior debt, but in front of the common equities. You're taking more risk than a senior lender most times, but you're taking less risk than the common equity. Sometimes we are, but in some cases, if you're not, you still have the ability to potentially take over a deal, or fire the manager, or even force a sale of the property if your covenants are not being met. So you have some of those protections, and you can earn a nice yield while doing that, and still have some control over the deal. So I think it's a lot of things I've been saying where, because the market is going through a lot of turbulence, a lot of these properties are struggling because of high supply, high interest rates, high operating costs like insurance, property taxes being reassessed. So now they're sitting there, and the lender's saying, "You got to pay us off," and the operator's saying, "We can't. If we don't have enough, income to get a new loan." So what's happened is it's in some ways constipated the balance sheet of all these lenders that aren't getting payoffs from older vintage deals to then lend to new deals. So there's a huge gap of debt in the market. Then on the equity side, investors are spooked, right? Sure. Maybe they're looking at a partial or even a total loss, and they're scared. If you can buy it at a reset basis where you're buying it at 25 to 30%, discount to prices a couple of years ago, you can get good capital in place now. That's really where it's a good time actually to get back in the market. We'll probably buy a couple deals that will operate as well next year, but we really are expanding and growing our preferred equity platform because there's just an abundance of deals because of that lack of available capital.